In this week's video, we'll review the latest charts, data sets, and studies to help us answer the question, is it possible the yield curve was right, but bearish positioning is wrong in 2023? We'll be moving quickly, so feel free to use the pause button on your video player. As mentioned numerous times over the past several weeks, there's no question the bears have a compelling argument in 2023. And last week we said that the charts told us we should be open to the bullish case as well. On the economy, April 20th, Ed Yardeni has got a lot of experience. He's been around a long time. Bottom line, we remain in the soft landing camp. Survey on your screen, for the most part, is a sentiment survey. It's an opinion. As JC noted, 95% of JP Morgan's investors think stocks fall the rest of the year. Another 5% think prices basically stay where they are. Almost none of them, less than 1%, think prices will rise. This was from JP Morgan. Similar results from a recent Bank of America survey. Investor allocation to equities relative to bonds has dropped to its lowest level since the global financial crisis. And as we know, when sentiment gets extreme, it can be a contrarian signal for the stock market. Common sense tells us with these responses, it's not surprising that the most recent Bank of America fund manager survey shows managers that are overweighted to defensive assets. Bonds, consumer staples, utilities, cash, and healthcare are the overweights. Underweighted to equities around the globe, especially the United States. Underweights to tech, industrials, and for the most part, foreign stocks, which we've shown numerous times in recent weeks are quite strong. And ultimately, that's why sentiment can act as a contrarian signal. If this is true, if fund managers are overweighted to defensive assets, and the stock market continues to hold up or move higher, then there's a lot of potential reallocation or fuel that could push the market even higher. We have to keep in mind, even though we're still seeing weak economic data, the labor market in the U.S. remains extremely strong. And it seems like many have forgotten that the S&P 500 fell peak to trough last year approximately 27%. It doesn't really matter where the market is today. It really matters where it went from peak to trough. What's in the rearview mirror is relevant as well. And making the argument that employment is the last to turn down is a little disingenuous as well here, because this is 12 weeks after the S&P 500 peaks in 2007. We're over 65 weeks from when the S&P 500 peaked in 2023. Bloomberg article dated April 16th of 2023. Bloomberg intelligence model implies U.S. recession started in 2022. Well, that's not particularly surprising. The model analyzes monthly changes in key inputs that factor into calling a recession, including capacity utilization, jobless claims, manufacturing, and sentiment. It indicates that an economic downturn possibly started in June of 2022. However, the same article says things may not be as bad as they seem. The worst of America's economic pain appears to have happened months ago, aka in the rearview mirror. And as long as this index over here stays above the late 2022 lows, the outlook based on history is favorable for the S&P 500 index. As we mentioned earlier, the model indicated that an economic downturn possibly started in June, and here's the key, and bottomed in December. Which means if that's the case, we could be looking at an example of less bad. Bottomed in December doesn't necessarily imply that the recession ended in December. It's just that the worst of the economic data came in December, and walking forward, we would be in less bad territory. Encapsulated in these bullet points, U.S. economy hit low in December. Backdrop signals significant support for stocks. Now, if all of this is true, it's possible that for the most part all of this was accurate, and it's also possible that the market's already taken all of that into account. If the Bloomberg model is accurate, the rate hikes did induce a mild recession. The yield curve was accurate in waving yellow and red flags. but it's possible the market has fallen far enough. And remember, we just said, the model said that the worst came in December. So economically, walking forward from December, we would be in less bad territory. And we know that markets tend to bottom when you hit less bad. And that coincided with, for the most part, the exact point where the markets started to improve, or at least the worst part of the markets. Remember, the NASDAQ bottomed in late December, coincident with that model, the economic model. And we noted in a tweet on January 4th of this year that the technicals and the market's tolerance for risk were improving noticeably. You may remember that improvement lasted until the hotter than expected NFP report in early February, and then the market had to deal with the banking issues and some very, very rare movements. Thus, it's logical to ask and answer. If the economy hit a low in December, wouldn't that somewhat imply that the worst is behind us relative to this topic as well? To help us answer that question, let's take a look at the St. Louis Fed Financial Stress Index. Financial crisis here, 2008. This is high stress in the system. Zero line here, the horizontal line, is normal or typical stress. You can see we did have a spike here in 2023. And if we zero in on the dot-com bust bear market, the financial crisis bear market, and the COVID plunge, all three of those cases were marked by recessions, the shaded areas. Notice during the bad periods, once this index got above this line here, when things were really bad in the economy and markets, it stayed above that line for a long period of time. It was above the line here in 2007, stays above it the entire time in 2008. Similar situation for COVID. We spike up and then we come back down below. And you'll notice when we come back down below, you know your market history, the stock market low is already in place in September of 2003. The stock market low is already in place in September of 2009. And the stock market low is already in place in June of 2020. Once again, that's when we come back to the zero line. So we wanted to know, when the index spikes up to this level, this was Friday, March 17th, at a reading of 1.56, and then comes back down and closes below the zero line, what typically happens? And as you can see in each one of these cases, that is what happened. We spiked up higher than 1.56, a lot higher than 1.56, and a lot higher than 1.56, and then eventually came back down. Spiked up, came back down. So we're looking for the first close back below the zero line after you hit 1.56 or higher. As you can see in the history of the index, it's only happened a handful of times. 1, 2, 3, 4 times. How did the stock market perform walking forward? The answer is extremely well. The market was higher in each case. 3 months later, 6 months later, 9 months later, 1 year later, and 2 years later. Average gain looking out 2 years, almost 19%. How about the drawdowns? Relatively muted. Average and median drawdown less than 5%. Well, obviously, we have to keep an eye on this. It's quite possible that this index is going to spike higher and exceed this level. In fact, it did pop back up right to about the zero line. This is the look of the chart earlier this week. We checked it before Friday's video. The latest reading, even lower. Better. The zero line is viewed as representing normal market conditions. We're better than normal right now. Longer it remains that way, the more relevant it becomes. But typically when that happens, things have calmed down. James Bullard from the Fed this week. Labor market seems very strong. It doesn't seem like the moment to be predicting that you have a recession in the second half of 2023. Something that we've covered in recent videos. If you're worried about this, or you saw this earlier in the week, Morgan Stanley's Mike Wilson, the percentage of stocks outperforming the S&P 500 on a 3-month rolling basis is the lowest on record. That is the market's way of warning us we are far from out of the woods in this bear market. A sentiment trader took a look at it. Conclusion: since 1928, very low levels of outperforming stocks were not consistent warnings of a market decline. Back to the topic. Is it possible the U.S. economy hit a low in December of last year? You can pause your video player. A lot of talk this week about how horrible the Philly Fed survey was. A little bit more balanced look here, and relative to the labor market. Every labor market metric is the same or hotter or much better than it was in 2019. And if you remember, your economic history, the economy was extremely strong in 2019, pre-COVID. Thus, it's still strong today. And if consumers aren't losing their jobs, they're not particularly afraid of losing their jobs, and their balance sheets remain in excellent shape, it's still difficult to envision why we're going to get a big hit to earnings. Now, those topics may change, meaning people may begin to lose their jobs at a rapid clip, and their balance sheets may begin to deteriorate at a rapid clip. But we trade the data sets in front of us, and right now, neither of those issues are a problem. How about the VIX? Does it align with the theory that it's possible the economy hit the low in December, and thus we should see significant support for stocks? As noted on Twitter, weekly VIX. This is 2022, never below or outside of the orange box. 2023, the entire year thus far, looks significantly different. Tweeted on the right side of your screen, clusters of implied volatility downturns are signs of healing. Something that just happened, only happened 39 times since 1990. Average maximum gain looking out 1 year, S&P 500, 19.1%. Positive at the end of 1 year, 95% of those 39 cases. Simply telling us to keep an open mind about the worst possibly being behind us. Left and right side of your screen, research from NDR, Ned Davis Research. Bond yields have fallen over the last 6 months and are now in a zone where returns for stocks have been strong. Right side of your screen, in the context of the combined seasonal, presidential, and 10-year cycles, the next few months for stocks have been historically strong. This is where we are year to date. We potentially may be getting a favorable daily setup on the daily DeMark chart. Had a 913 here near the October low. Had a 9 and a 13 and a 9 here waving yellow or red flags, but that's been negated by this 9 up here, a buy setup. We have a 910, which is similar to this point here and very, very close to potentially printing a 913. Also noteworthy, the fact that this line here, this TDST line, turned from dotted to solid tells us we have a qualified break from a probability perspective. What does that mean? That means the downtrend, the odds of it flipping to an uptrend, have improved. And that's really what we've been talking about in these videos for several weeks. The markets are trying to flip from a downtrend to an uptrend, and this is in the successful flip camp as of Friday's session. Still in the soft landing camp. High degree of pessimism that stocks can move higher. Significant defensive positioning. A still strong labor market. A data set going back to the 1970s that tells us it's possible the worst is in the rearview mirror. A big decline already in the rearview mirror. Consumers that are still spending. A VIX that seems less concerned, and we could be days away from a positive setup here. And add to that, according to the Commitment of Traders report, large speculators are holding the largest net short futures position in the E-minis since 2007. Similar cases, 1, 2, 3, 4. This is the fifth shown on your screen. This one turned out to be bullish. This one eventually turned out to be bullish. This one eventually turned out to be bullish. This one did not. But notice, this is in 2007, 2008. Investors are the most bearish on stocks versus bonds since when? 2009. That's near the low. This is also a potential source of fuel to the upside. Keyword being potential. So having said all that, and in that context, we've got the left side of the screen that says the worst could be in the rearview mirror. And we've got the right side of the screen, the view held by many that the worst is yet to come. Left side of the screen, inflation is cooling and the Fed is close to pausing. Right side of the screen, inflation is still a problem and thus the Fed is still a problem. Got a lot of moving parts here. If we look at the charts in front of us, do they agree with the left side or the right side? Left side or the right side? Do they align more with this case or this case? And do they tend to align with or contradict that the worst is in the rearview mirror? 100% of this week's video is being recorded after the close on Friday, April 21st. We'll be using numerous charts dated April 20th. There was really no need to update them. The Dow, S&P 500, NASDAQ, and Russell were all up during Friday's session, and the VIX was down, trading well below 20 at 16 and change. This is what risk off looks like in 2022. This is the October low in the S&P 500 down here. Does the present day chart look better, worse, or about the same? The answer is it looks significantly better. Down here, blue, the fastest moving averages on the bottom, prices below all the moving averages. Up here, blue, the fastest moving averages near the top of the cluster, and prices above all the moving averages. Wildly convincing? No. Much improved? Yes. It also says that the thrusts that occurred in this window here last year and the thrusts that occurred in January of this year still may be valid. This is a low, it's a higher low, higher low, this is a high, and this is a higher high. How about this versus this? Does the chart since the October low look different relative to this looking here during the full bore risk off period? Here's October of last year. The answer is yes. Here's a high, here's a lower high, here's a low, here's a lower low. The ratio of 1 to 3 month T-bills to 3 to 7 year treasuries, meaning this is highly defensive. This is still concerned about the Fed. This is still concerned about inflation. Starting to look different. Notice we're down around the 250-day moving average. We never touched the 250-day moving average, never came close to it in 2022. A convincing turn yet? No, not convincing. Does it help us keep an open mind about something different? Yes, it does. Everything that applied to the last chart applies to this chart as well. Like to see more improvement here. Improvement since the October low? Yes. We'd prefer to see this ratio get out here. That may happen. Hasn't happened yet, and that is reflected in our allocations. It's an updated version of the chart we covered last week. No question, this is showing improvement on many fronts, willing to go out further relative to maturities, which means taking more risk, and willing to favor riskier corporates relative to backed by the full faith and credit of the U.S. government treasuries. How about this chart? Is it possible the worst is behind us? If that's true, then this chart should look significantly improved relative to October of last year. And maybe more importantly, it should look different relative to the failed counter-trend moves that occurred in 2022. Didn't produce. Present day looks significantly different. Price relative to the moving averages, which speaks to the trend. Trying to flip from a downtrend to an uptrend, which is exactly what this blue line is about here on the daily chart. Trying to flip from a downtrend to an uptrend. This is one of your leaders, EFA, October low, even the growth version. Does this look significantly different down here relative to what we have in the present day? Yes, it does. This is a series of lower lows and lower highs. This is a series of higher highs and higher lows. Does this chart align with the left side of the screen or the right side of the screen down here? Here's the highest high in this ratio in 2021. Fed pivots in here. This is what the bear market looks like. This is full bore risk off. We've exceeded this high here, come back and retested it, and then we've printed a higher high. This looks like a successful turn from a downtrend to an uptrend. S&P 500, it's a laggard. It's got work to do. VGK in isolation this week on Friday after the close on April 21st just printed the highest high relative to the rally attempt off the October low. Downtrend to an uptrend. All the commentary relative to the chart in front of us. VGK in isolation, VGK relative to more defensive-oriented IEI. If we're going to go into a global earnings recession and central banks around the globe are about to cut rates because the economy and earnings are about to fall off a cliff, is this what we would expect this chart to look like? We asked ChatGPT, please respond as if you are an expert in the field of AI consulting. What are the projected growth rates of AI adoption in the global economy, and where are the best opportunities for productivity enhancements? Answer. This is risk off. This is BOTZ, the Global Robotics and Artificial Intelligence ETF relative to IEI. This looks different and much improved. And there's no question, this look here relative to this look here, the present day looks a lot better with the left side relative to where we were in October of last year. Doesn't predict anything, simply speaks to odds. If nothing else, we've built a nice base here. We were not able to do that in here. Let's assume we're on the right side of the screen walking forward. Inflation is still a problem. The Fed is still a problem, and hence you could add a third bullet point. Interest rates are still a problem. If that were true, wouldn't we expect that housing stocks would be doing very, very poorly, given the housing market is very, very sensitive to rising interest rates? That's exactly what happened early in 2022. Chairman Powell pivots right in here, and the ratio of home builder stocks relative to 3 to 7 year treasuries turned around and started to move in the other direction. And here in June of 2022, had a full-bore bearish look with blue, the fastest moving average on the bottom. The slopes of all the moving averages were down and price was below all of the moving averages. Thus, if this is true and this is true and interest rates are still a problem, then we wouldn't expect this ratio to do anything other than to continue to move in this direction. So how does it look today? Better, worse, or about the same? Does it look more like risk on, or does it look more like risk off? This is Thursday's close. Compare and contrast the look here to here. Compare and contrast the look here. Similar ETF, but different. This is XHB. The prior was ITB. Compare and contrast. Compare and contrast. But blue, the fastest moving averages on top. Prices above all of the moving averages, and as far as this ratio goes, it just recently exceeded the Q1 highs from 2023, telling us to keep an open mind about better than expected outcomes. Powell pivots, retires transitory, and the ratio of shorting the S&P 500 relative to 3 to 7 year treasuries rises, risk off into October 2022. Today, better, worse, or about the same? Still look like risk off? It's probably fair to say that the look in the present day says the odds of A versus B have shifted. Also speaks to probabilities. Economically sensitive semiconductors. It's a high dividend, low volatility, SPHD, relative to interest rate sensitive, Fed sensitive, and inflation sensitive tech stocks. Not surprisingly, the Fed pivots, especially with the benefit of hindsight. Fed pivots here almost to the day. This ratio reverses, and this is confident risk off in here. Full bore bull for risk off. Has anything changed since the NASDAQ bottomed in late December of last year? I think it's probably fair to say that this looks significantly different relative to this. Same thing can be said about this point and this point relative to this point and this point. Has work to do, but at least we've moved into an indecisive look relative to this and this. And remember, some of your market leaders have exceeded this high, they've exceeded this high, and they've even exceeded these highs. It's possible that the laggards will follow. NASDAQ bottoms. Does this look improved? Does it look different? Yes, it looks different. We're doing things in here that we never did in here. If we take the same ratio, VUG divided by IEI, and we simply focus on the trends, bullish breakout for blue above black. We can say this is a retest, and then it printed a higher high. Same ratio, if we zero in on the 200-day moving average, slope rolls over, slope trying to turn back up. Speaks to odds between A and B. Chairman Powell pivots up here. The ratio of tech to treasuries reverses, goes from an uptrend to a downtrend. Here's October of 2022. It's probably fair to say this is a significantly improved look and speaks to the odds of A versus B. Is it possible this is going to change? Absolutely, positively, yes, but we trade the chart in front of us. Right now, price is above all the moving averages. Blue, the fastest moving average, is on top. It's quite a bit different relative to this look down here in October of last year. Even quite a bit different relative to this look here in early January of this year. This is another ratio that has exceeded the February or Q1 high of 2023. Is it possible that inflation is calming down in a meaningful way? In terms of commodities, yes. Twitter account here, here's the handle. Nothing signals a recession like Amex beating on revenues. This image was accompanied with the tweet. American Express posted a 22% jump in revenue for the first 3 months of the year as Americans kept spending. What did they keep spending on? Particularly on travel, entertainment, and restaurants. Discretionary spending, discretionary spending, discretionary spending. Credit performance remaining best in class. It's been a very, very difficult time to be a trend follower. And again, with the benefit of hindsight, not particularly surprising, given all of the market intervention between 2008 and really the present day. And given that the Fed told the markets over and over and over again, including in 2021, that the Fed had no plans to raise interest rates or reduce bond purchases, which means stop QE. And after that, they slammed on the brakes and did that 180 and went from all of this being the forward guidance to the markets, including banks, I might add, to hiking further and faster than any time in modern history. Thus, we had extremely high volatility in interest rates, which is extremely difficult for market participants, and the Fed, not surprisingly, had a credibility problem. And even in 2023, interest rate volatility relative to what we had seen in the rearview mirror, off the charts, contributing to this, and this. That's the bad news. And I might add, all market participants had to deal with this. Here's another chart that illustrates just how rare and difficult things have been in the rearview mirror looking back, let's say 12 to 18 months. And we bring it up for this reason. Because it's not likely that the next 12 to 18 months are going to be as difficult. Doesn't mean they're going to be easy. So all of this, all of this, all of this, all of this, and all of this, unbelievably, Bank of America Fund Manager Survey, it took the market and sentiment from the highest reading here. This reading here is higher than any reading looking back approximately 20 plus years. We went from the highest reading and dropped like a stone to the lowest reading on the entire chart. And you'll also notice when you get down here, typically looking out 12 to 18 months, good things happen. This is extremely rare, telling us to keep an open mind about bullet point A and bullet point B, or the concept of less bad walking forward. Notice, less bad doesn't mean great, doesn't mean easy, doesn't mean the market goes straight up. Step one would be what's happened the last 2 weeks. We'd just like to see the market calm down a little bit. That would be a good first step. Is there any other reason to believe that it could get a little bit less volatile and a little easier on a relative basis walking forward? Yes, we've talked about this several times. We now have weekly TSI on the S&P 500. It's been in positive territory for 12 consecutive weeks. That's not what happened here on this failed counter-trend rally in 2002. That's not what happened here on this failed counter-trend rally in 2008. Couldn't even get close to the zero line. Couldn't get one close above it here. We've had 12 consecutive weekly closes above zero in 2023, which looks more like 2003 after the major low and 2009 after the major low. In fact, look at price here. Can you see price very much above the moving averages? How about here on this failed rally attempt? Does this and this look any different from this? If you're looking at it objectively, the answer is yes. Price is above it here in Q1. Price is back above it again later in the year. And we did get some indecisiveness right here for several weeks after the major low in 2009, telling us that some type of indecisiveness in here isn't really all that unusual. Major low here, several weeks of indecisiveness near the moving averages here. Major low here, several weeks of indecisiveness in here. In fact, this is really several months of indecisiveness, and then we move higher. Very, very similar concepts here for the NASDAQ. 5 consecutive weeks with weekly TSI printing a black above zero. The interest rate sensitive, Fed policy sensitive, and inflation sensitive tech sector above zero for 11 consecutive weeks. Quite a bit different from the failed rally in 2002, quite a bit different from the failed rally in 2008, and maybe more impressively, this is our look in the present day, which looks more like post-low periods. This is our look, even in this context, here. Some pretty impressive resiliency. Thus, it's possible, once again with the benefit of hindsight, that the Fed rate hikes did cause a recession. It started in June of last year. And it's also possible that the yield curve was right in predicting a recession. It started last year. And it's also possible that if we're in less bad territory and the worst of the economic data is in the rearview mirror, then it's possible the market has fallen far enough. That's a big drop on a historical basis. And this is hard data here, and it's always very, very difficult to embrace improving data after a horrible and volatile bear market. The purpose of this week's video is simply to say we should continue to keep an open mind about better than expected outcomes. Our allocations reflect the fact that this chart is not all that convincing in its present form, and that's true of many of the charts that we've covered, but it is improved. And our allocations also reflect the fact that if inflation remains high, the second half of the year or the rest of the year could be similar to the early part of 2022, where stocks, bonds, and gold all struggled. And it's also possible that even though the stress index has calmed down a little bit, we could still have a credit event in 2023. Notice I say possible, but right now we trade the chart in front of us. And the charts in front of us tell us it's possible. If a recession started in June of 2022 and the economy began to improve in December, meaning we moved into less bad territory, then it's possible the yield curve was right, the Fed's policies did cause a mild recession, but the impact to earnings was muted due to several factors, including A, B, and C. And it's also possible that the timing of the entire cycle was impacted by A, B, and C. A lot of the commentary you read seems to forget that the S&P 500 had a massive drawdown last year, 27%. And thus, it's possible we are in less bad territory. Doesn't mean we go up every day. Doesn't mean it's easy from here, but it's possible it could be easier and less volatile, and it's possible the October low from last year holds. It's also possible the global liquidity cycle is in the process of turning from unfavorable to favorable. And we have to keep in mind, many of the charts, including the chart of the S&P 500, they're much improved, but not highly confident nor definitive. But remember, after many of the major lows that we just covered, it wasn't unusual for the market to be indecisive for several weeks or even several months. So all of this, the good, the bad, and the ugly, is reflected in our allocations. We're not making any assumptions about any topic on any time frame. We're not making any assumptions about what our next moves are going to be. Are we going to redeploy additional cash? Or are we going to take additional defensive action at some point? We'll continue to take it day by day, respecting that the market, for now, is still below 4,200 and still in a range. But the fact that we're in a range, and in a range at higher levels currently, is another form of incremental improvement. Even if good things do happen between now and the end of the year, doesn't mean good things have to happen in the short run. And anything can happen in markets, including lower lows. It's possible we're going to violate the October low from last year. And thus, we all know, the only way any of this can work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.